On September 15, 2008, Lehman Brothers, a 158-year-old company and the fourth largest investment bank in the United States, filed for Chapter 11 bankruptcy protection. This marked the beginning of the 2008 financial crisis, which led to the Great Recession, with losses amounting to upwards of $11.2 trillion, the worst financial crisis since the Great Depression. What happened? Actually, there were a series of scams underlying this financial disaster that I will explain today. The root cause of it all lies in subprime loans, which are loans made to people who are not financially qualified to receive them. Starting in the early 21st century, mortgage companies like Bank of America began luring consumers into signing subprime loans using tactics like adjustable rate mortgages. Mortgage companies then sold these loans, which offered mortgage returns for a fee, to investment banks such as Goldman Sachs or Lehman Brothers. In turn, these investment banks consolidated the loans into financial products known as asset-backed securities. To market these securities to investors, the investment banks tricked credit rating agencies such as Standard & Poor's into believing that multiple C-rated loans could then be turned into an A-rated security on the grounds that the probability of multiple loans simultaneously defaulting is extremely low. After successfully convincing these credit rating agencies, the securities were sold to investors who trusted the credit rating agency's judgment. With the housing market booming, market value of houses continued to increase, which meant that consumers were able to make payments on time, and these payments eventually reached investors. Mortgage companies continued to make subprime loans, and investment banks continued to make securities. In other words, everyone was happy. Until 2007. In 2007, the housing market bubble burst. In other words, demand for houses began going down. Consumers were unable to refinance their mortgages, which meant that they were defaulting on their loans. When these consumers realized that their mortgages were worth more than their house value, foreclosure seemed an attractive option for many who just packed up and left. This is a scenario that was vividly depicted in last year's Oscar-winning film, The Big Short. Of course, this had a ripple effect, ultimately ending in the tricked investors suffering dramatic losses when the price of the security dropped severely. But that's not all. Way back in 2004, a select few hedge funds saw through the unsustainability of the housing market boom and concocted a new form of insurance to protect these asset-backed securities. If the price of the asset-backed securities went down, insurers would have to pay up. Since the insurers trusted the rating agencies who had given these securities a rating of A, which meant low risk, the insurers believed that this insurance plan was ludicrous, but also lucrative. Why pass up free money, right? Thus, the insurance companies who ate up these deals became the biggest sufferers when the price of the security did indeed suffer dramatically. In fact, Lehman Brothers was one of these entities. This is one of the main reasons for the meltdown of the financial system. Despite huge financial losses and pains caused by the subsequent recession, no high-level executives of major investment banks were convicted. After this whole ordeal, the United States government passed laws trying to curb these scams in the future, but seemingly to no avail. Financial products suspiciously similar to the asset-backed securities of the past popped up back on the market just last year. You would think that people would learn from their past mistakes, but the future looks bleak. I guess greed can never be cured.